Hey guys, it's Randy today because today we're kicking off something new. I'm joined with Sharon Thompson. Hi Sharon, how are you?
Hi, good.
So Sharon and I are excited because we're going to be bringing you Money Matters every Friday. And so what Money Matters is really our way of helping lean into our community, our spheres, our friends, our clients, and helping you to make more informed decisions when it comes to money, right? So something that's really cool is that Sharon and I have done several transactions together. And something I think we share is that heart of a teacher to just empower people to make informed decisions. And I know for myself, Sharon, I didn't know a lot. I still don't there's still times I'm like, hey, Sharon, how does this work? Or what's that? Right. I'm always learning. And so I feel that it's so important to talk about money and, how to prepare yourself to buy a house and how to prepare yourself to invest and all of these things. Right. So Sharon, what do you have to add to what we're going to be doing here?
I think, we talk to a lot of our clients and, you know, if we can get them in the early stages, we talk about how we can do some credit repair for better credit scores, how we can do just minor changes to increase purchase power. And I just think that, we're educating them sometimes a little too late because they're ready to buy a house and we just have to jump on it as opposed to giving us sometimes even just a little head start would be great. So I think that we're going to be letting people know good information about how to buy a house, how to structure yourself, how to put yourself in the best position possible when you're ready to either buy, upgrade, or start looking into investment properties, how to make your money work for you.
Yeah, I think that is perfect. So each Friday, we're going to have a different topic that we're going to bring you, but please know that you can always jump in here on the comments, ask us questions. We will always pay attention to those questions, even if they're not after the fact when we're not live, and we'll come back and answer those. So we just want you to consider us a resource that you can lean into, ask questions. And so on that note, today we are talking about a pretty hot topic, right? So it is the election. How do we feel interest rates are going to relate to the election? And so we're going to make this a really simple forum. I'm just going to ask Sharon some questions. And so I'll start with question number one. And this one's pretty simple, but honestly, some people ask this question. Does the president have any decision over rates? So is that something people should be concerned about?
The president doesn't directly have influence over rates. Neither does Congress, the Senate, or even the Federal Reserve. And I think that that's a common misconception that when the Fed drops rates, mortgage rates are dropping. That's not necessarily true. In fact, sometimes it can impact them in the opposite way and make mortgage rates go up. The mortgage rates are a direct reflection of the financial district, what's going on in our financial district, and not just in the United States, but worldwide. I will look at trading in China on a Sunday and know what it's going to dictate for rates on a Monday morning. So the president he doesn't directly have an influence on mortgage interest rates.
Got it. Obviously this is a loaded question and I don't know that, there is a for sure answer here, but this is definitely a question that we have both heard is how will the election affect rates?
Well, I think that just like the polls, it's a lot of ifs, whats, maybes, who really knows. However, what we're already seeing this morning is we're seeing the bond market go up, which means that's going to affect rates, the mortgage-backed securities. The reason we saw it go up this morning was because Biden took over Pennsylvania and Georgia overnight, which in the financial world looks at a Biden win as a negative only because Trump is more of a business minded person. So the market kind of looks at it as what's going to happen to businesses? Are we going to see heavy taxation with a Biden win? So therefore, it kind of turns rates against us a little bit. However, the in the long run, I also think that the people look at a Biden win as change in COVID, possibly hope, and that might turn rates back into the other direction after the election's over.
Right. I think right now it's just a tense time of unknown, right? So everybody's just kind of holding their breath right now. And I think you and I both have to chuckle because I do a few different shows and some of my partners are across the country, but you and I are both here in good old Nevada. And who would have ever thought that the election Nevada would play a huge role in the election? So I have to say that I've enjoyed my feed being filled with Nevada memes, because I at least feel like the Nevada memes have have definitely unified Nevadans. So I'm like, oh great, we can all make fun of ourselves together. So so that has been good. Okay, so so really, what does all of this mean? So what does this mean as far as the election? What does it all boil down to, for mortgages?
I mean, once again, what does it mean for us? What does it mean for our clients? What does it mean for buyers, refinances, everything? We don't exactly know. It's a bunch of what ifs, maybes, and we're just trying to come up with our best conclusion of what's going to happen at the end of this election. In my personal opinion, being in mortgages for 20 years, we are at rock bottom rates. We have never, ever, ever seen rates this low, ever in our lifetime. So the only conclusion that we can come up with is that rates do eventually have to come up. And I tell all my clients, and I swear my team is so sick of hearing me say this. When I did my purchase back in March, I got a 3.5 and I was doing the moonwalk. I was like, we got a 3.5. It's the greatest day. So are rates going to come up? Yeah. But are we going to stay in the threes? I definitely think that through 2021, we will see rates stay at record lows in the threes. But I think that the sub three will start to go away slowly. Another thing that we talk about with the election and everything that's going on in the world is a lot of people, Black Friday's coming up. Christmas shopping is coming up. What we historically see is that between October and January, we start to see rates come up if there's consumer confidence out there. So if the people are for Biden and they're really confident about where the market's going to turn, they're going to shop. And then we are going to see rates slowly start to peak up. And like I said, rates I don't think they're going to go back into the fours anytime soon, but a 3.5 is way different than a 2.875.
Right. So a question that I get a lot is, obviously, should I buy right now? And for me, I always tell my clients and people that I'm speaking to that I think that's a really individual question. And I think that you need to look at yourself, like, should you buy is dependent. For me, I see it as more of, do you have stable work? Do you feel good about your job? Are you going to stay put, long term? Or are you going to be in a position that you have to turn around and sell in 6 months? So you look at these things, and those are the questions that I'm asking. But, from a mortgage standpoint, when somebody asks you, should you buy, what are you saying?
I'm pro own. I mean, I have done really well in real estate. When I first moved to Reno 2 years ago, everybody said the Reno market's going to take a dip. And I said, I don't even care if it takes a 5% dip. I'd rather own my home and start putting money towards principal as opposed to renting to see what the market does. With that said, in those 2 years, we've gained almost $50,000 equity when everybody told me I would lose. I've ran the numbers every way to Sunday. And I truly believe that the people that are waiting to see what happens to the economy, the risk does not outweigh the reward. We are in sub 3% interest rates. The payments are just insanely low. And with that said, I've ran the examples every way to Sunday in the sense that you take a $400,000 mortgage and you take a 2.875% interest rate, even if rates only go up to a 3.5 or even a 3.25, you're talking $100 difference in a payment. So what are you waiting for? You're waiting for a hope that the market's going to take a dip. And right now, like we said, with COVID still being a strong, strong player in what the financial market's doing, and with other people going through a second wave of shutdowns, now is the time to buy. You're never going to see these interest rates this low again. Even if we talk about investments, we're seeing rental properties, interest rates 3.5, 3.625. When have you ever even seen that when buying an investment property?
Yeah, it's funny that you said that people told you that, that you're going to see a drop, because I'm a native Nevadan, multi-generation, and I can't tell you how many times that I've sold a house to a client. And I mean, I always have a hard conversation with the client, like, hey, here's the thing. I don't really think there's a bad time to buy a home. I just don't. Again, I think it's a personal thing. If it makes sense for you to own a home, which 9 times out of 10, I feel it does, it's not a bad time to buy. There are bad times to sell, right? There are bad times to sell homes. That's a difference. And so I always talk to my clients about, make sure that you're not going to be totally unhappy here in a year, because I never want my clients to be in that, that cornered position of having to sell and it not being the good time to sell, right? So anyhow, in those conversations, I've just thought to myself, this has got to be the top. And I stopped thinking that this year. I'm like, I'm done thinking it, because I thought it's got to be the top way too many times now. And in fact, we've seen over 10, 12, 14% increases year over year in obviously those are also historical. You don't normally see that kind of return on investment. But I agree with you. I think homeownership, something I've seen as a byproduct of COVID is how much more home ownership means to people. The security in home ownership, right? The security in knowing this is my home, this is my safe place. We also obviously saw the second home markets take a massive boom. Like I want to say that if I was to pinpoint one of the top 3 effects of COVID, I would say the second market homes, those markets have exploded. Would you agree? Those are crazy.
100%. We've seen a lot of people do just an upgrade too, where they turn that first home into a rental property and upgrade into that other home. People are taking full advantage of this market, and the people that are going to win and win big in the end.
Well, and that's exactly what I was going to say is people are they're making home more recreational than I think that they ever have. So I think that, and it's, I'm not saying it's a bad thing, but I think we had become a society that spent a lot of time outside of the home and a lot of, just on a daily basis outside of the home. And I think now people are I've always been a homebody. So it's funny to me because I've always been like, I was the mom that was like, I need the trampoline, I need the pool, I need the basketball court. Like and my kids were like, Mom, you don't want us to leave the house? And I was like, no. and so with COVID, I'm like, see, you like Mom wanting everything at home. We have it all. So
we're prepared.
So I have to chuckle, but I think now that's kind of a wave. So I think that's good. And we do have a comment. Sammy said, this is such a helpful live. The hard conversations during hard times can be difficult to navigate. And boy, can we relate to that. Sammy, I recall Sharon and I in particular had a couple clients going through this right when COVID hit. And it was hard because those conversations are hard to navigate because we were kind of flying blind. I want to say that probably by June, maybe July, but probably by June, I felt like we had a little bit of footing on what COVID looked like. Would you agree, Sharon? And it was like, I know by July, we were like, all right, here's what's going to happen. Let's talk about the stress on the mortgage industry. Let's talk about appraisals. Let's talk about delays. And by August and September, we're like, you should probably definitely consider a 45-day mortgage. So we felt some of those things happening, right, Sharon?
Oh God, still, it's crazy.
Yeah, it definitely is. Okay. So another question that we have is, what is the benefit of someone buying a home with so much uncertainty in a country divided?
I would say personally, I go back to what I tell everybody, which is real estate is the best thing you can own. Out of everything out there that you can put your money in, you can touch it, you can feel it, you can see it. Real estate is the best thing that you can own in uncertainty. We all have seen the markets drop back in 2008. We had the huge mortgage crisis. But guess what? Every single market, Reno, California, New York, every single market recovered, and all those people now have equity. So even during that uncertain time where people were short selling left and right, to this day, people are now back into equity. They have homes, and during uncertain times, like you said, they have a place to live.
Well, and I think again, something that's a little bit different is obviously how the mortgages are done. So something that you as a consumer can be a little more confident in is that the loan products are no longer what they were back before that crash. And so, I mean, I was seeing people get completely no doc, no stated loans, right? Which means that basically the bank just said you're approved. And which I have to chuckle because sometimes when you're in the loan process and you're like, oh, you need doc 442, it's frustrating. But again, these are good things that the mortgage industry is put into place because it does protect you and it helps make sure that, again, the biggest thing that I think is important when you're making this decision is how is my stability? If you foresee a job loss coming in 6 weeks, it's probably not a good time to buy a house, right? If you, I had a client during COVID. I had a client who had good reserves and was purchasing a house. And so I was like, well, you have your reserves. Well, she came in, we talked about it, and we were going through it, and we knew her job was probably going to go away because she worked in the beauty industry and was going to get a shutdown. And so we realized that if she depleted all of her savings going into the house, she wouldn't have any pad to live. And so we actually put her purchase on hold until she got back to work. it felt like the reserves were up a little bit. And so again, I think that I think there's a lot of benefits, but another thing I want to make sure that we reiterate to people that might not understand this is that you probably can't outsave interest rate savings. So a lot of times clients say to me, I'm just going to hold off and I'm going to save some more money. And I always, not that I'm trying to be overstep or be overbearing, but I say, what's your savings plan? Because how are you going to outsave the current interest rate? If interest rates go up by 0.25%, it's going to wipe out that savings that you just had. Do you have a huge job promotion coming up that's going to cause you to be able to save $10, $20, $30,000 more? 9 times out of 10, you can't outsave that. And that's before you even talk about the equity that you could gain in the time that you'd be in the house. And so I think that question kind of brings us to the next question which is really important in today's market, which is, should I go over asking? What do you think about that one, Sharon?
I mean, we've been battling that one for the last couple months, and we are now, I think that we're now really talking about it a lot with our clients. You need to go over asking if you want to get this house. You have to go over asking if we want to win it. And I just had a client the other day that we were going 5,000 over asking, and I crunched the numbers for him. I said, you're talking $20 a month. And then I did it for the year. It was something like $250 for the year. I apologize if my math is off. And I said, I've seen you spend more money on dinner in one night than the cost for a year. So you're going to walk away from your dream home for $20 a month. And in the meantime, like we've talked about, if you look at an amortization schedule on, typically on like a $300,000 loan, you're putting $5,000 towards principal every month. So you're going to walk away from putting $5,000 towards principal every month, which is basically a savings account for yourself, over $20 a month. The difference is we have to talk about, do they have that in savings? If the house doesn't appraise, how comfortable are we? But even if you can even be more attractive just at $1,000 or $2,000, and I think it's, what do I think about going over asking? I think that people get caught up in that $1,000 number as opposed to taking it down to that monthly number. And on top of that, if you're going to be in the house more than 5 years, what have we talked about? You're going to recoup it in equity, 100%. You're going to live there long term. And then what you're putting towards principal as opposed to renting or staying in the other home that you've been wanting to upgrade from, and then you walk away from those super low interest rates. So should I go over asking? Yeah, I mean, the history tells us that the market will bounce back. So even if you went a little bit over asking, we took a small dip in the market, we know in a 5-year term, we're going to be okay.
Yeah, I couldn't agree more. Something that I've always been really intentional about is breaking things down for my clients, because I think when we look at the big numbers, like you said, they can be a little bit overwhelming. So when you ask somebody to pay $5,000 or $10,000 over asking, I think that immediately, I as a buyer would be like, oh, $5,000 or $10,000. That I personally was in a transaction recently, and we were doing some negotiation, and I really wanted to see. We were probably $40,000 to $50,000 off of what I wanted to see, and I literally had to put myself in a buyer's shoes, and I had to ask myself first and foremost, for $40,000 or $50,000, would I want to lose this particular property, right? No, I wouldn't. And then when I break that down to payment, especially when you're looking at $5,000 or $10,000, and I always tell clients, just so you guys know, in a normal market, I tell my clients, don't get hung up on saying, okay, this house is $30,000 more. We know that $10,000, and correct me if I'm wrong, but $10,000, give or take, depending on your interest rate and your mortgage, you're probably anywhere from $50 to $70 a month on payment. Is that about right?
Yes.
Okay. So if you're looking at $20,000, you're looking at $100 a month. So what I tell my clients is, don't look at, is this house worth $20,000 more? Ask yourself, is this worth $100 more a month? And I always have to joke, because way back when my husband and I were house hunting, I told him that. And then we went through the house, and I was like, I'll pay $50 more for the kitchen. He's like, I got $100 garage. We got 50 out the backyard. And so all of a sudden we were like, oh, we're willing to pay like $700 more a month for this house. And so just up our budget to the $1 million mark, which obviously wasn't possible at the time. But point being is, all of a sudden you feel a little bit better, because you can just say like, hey, this kitchen is worth this, or this neighborhood is worth this. And also I would, with how things are going, again, none of us have a crystal ball, but how things are going. I had one client who I was speaking to, and Sharon, we actually worked this client together, and he kind of got hit a couple times. So he got hit on the sale of his home with a low appraisal. And then he had to come out of pocket on the other side to get the house. And so he had that hard, it was closer to probably $15,000. And he was just like, I don't know, he'd have to come up with this, because that is a big thing. Again, we're not downplaying the fact that when you're coming up with this money above appraisal, or, that's a big number. And so his out of pocket number was rising. And something else I just want to share with you is how important it is to assess your asset. So what I was explaining to him is, here, listen, I believe firmly that you're going to see this money back in probably a year and a half max, right? But furthermore, when the music stops, it's what asset are you holding? So it's like a game of musical chairs. And in his case, he had a manufactured home that was a nice home. It was a good home. It did its job. It did its purpose. But it made total sense for him to move from that manufactured house into this stick-built house. Not only did it serve his family better, but again, when the music stops, he's holding a better asset. And so in that case, when you ask me if somebody's, should they pay $5,000 above appraisal? Yes, when you're going to be holding a stronger asset that's a stick-built home versus manufactured or something like that, or, a better area or whatever the case may be, compare your assets. If it makes sense to go into the higher asset that's going to give you a bigger return, it makes sense to pay a little bit more to get there.
Agreed. 100%.
So, Sharon, I got to tell you, I love this. So Sarah said, love that. You probably can't outsave interest savings. And so something, obviously when Sharon and I talked about doing this show, we were thinking about wanting to provide more value to our, our personal friends and family and our audience and our clients. And again, we have a lot of people that we come in contact with that aren't just ready. So we were like, how do we build a, library of content to help people to get ready? But Sarah's actually an agent. So I love that too. And so I love, agents. I want to just encourage you, if you have questions about this market, or, maybe your clients are seeing certain things and they have questions, please bring us those as well. We definitely want to answer them. So every Friday we'll be going live. I think we got all of our questions answered today. Sharon, did you have anything else that you wanted to add?
I'll just go back to, real quick, another client that we worked together. He actually did a review for me, and I was so impressed. I couldn't believe that he remembered everything that I taught him. He was in a new build situation where we had 3 to 4 months before he was going to buy. And so I said, let's pull your credit. Let's take a look at what we're looking at. And I said, okay, between now and September, if you can do these 3 things, if I were locking you today, I could save you a 1/4 point. And he's like, really? And they were minor things that we were able to do in his credit. And so, when we talk about every Friday, like, these are the things that we want to talk about. How can we continue to put our buyers in the best position possible? He was already in contract on that new build, and it was going to be what it was going to be, but he worked really hard over those 3 months. And as opposed to looking at a 3 1/4, even though we did see a shift in the market, we got him all the way down to 2.75. Last point I want to make that is, we talk about, what if the market takes a dip? What if we see some correction? And once again, those are big ifs, right? What if? What if? What if we don't and you missed out? What if we don't and you didn't upgrade? And like you said, what if we don't and you didn't take advantage from going from that manufactured home to a stick-built home? When we talk about the difference in price, you and I've talked about this. I've ran the numbers every way to Sunday, and on a $400,000 home, the difference between a 2.875 and a 3.5 is $100, about $100 on the same exact home. But if you just take a $5,000 correction, like, oh, my $400,000 home is now $395, which that's if we see a correction, the difference is like $20. So, what we talked about is, if you're going to be in these homes more than 5 years, people need to get off the shelf. They've got to stop waiting for the apocalypse to come. Because what we've seen, the apocalypse came in the form of COVID, and the industry went insane. So that's all I have.
Well, and I think that that's a really good point. I mean, COVID was obviously something nobody saw coming. And so in the next weeks to come, we're going to discuss an array of different topics, because obviously, investors were hit in a way that they were never imagined to be hit. So, there was a lot of things. The industry, the mortgage industry, I don't remember the exact numbers, but I think on average, you guys do like $1 trillion a year. And year to date, you guys are at like 12 trillion. So, I mean, if you just think about that on any industry, if your numbers were up by that, what would your business look like? Especially if most people, just think about it, the apocalypse, as she called it, which was COVID. What did that cause most business owners to do? Scale back, right? I mean, it immediately caused people to scale back. And so all these people laid off and lessened their workforce. And then the industry went and skyrocketed. So now you're shorthanded and you have 10 times the amount of business that you normally have. And so, the good thing that we're trying to do, because here's the truth. We can't promise you a turbulence-free transaction. We just can't. We have there's new overlays, there's new things that we don't know about. But something that I've always taken pride in is that when I work side by side with any partner or anyone in the industry, the reason I do it isn't because things go perfect, but it's because how they rise to the occasion when they don't. And so what we are doing is we're staying side by side. We're strategizing, we're planning things. And here's the thing: sometimes it makes sense to go elsewhere. And what I love, something that was huge for me. In fact, Sharon, I don't think you actually heard me talk about this, but I did a morning show the other day that is it's an agent audience, and we were talking about making sure you rise to the occasion when things go wrong. And I actually used you as an example because there was a situation where a certain overlay that didn't come until literally the last minute caused the deal to not be able to close, which caused the client to actually be homeless and have to go into a hotel. And something that stuck out to me really good is there was another lender that came in and did a terrific job and got the loan closed, and that was great, and everybody worked together to facilitate that, which was awesome. But something that stood out to me was when it was all said and done, I noticed that the client continued to go back to Sharon and ask questions and continued to go back to Sharon. And so I thought to myself, as a business professional, what was the trigger for that? Because again, somebody else came in and saved the day. Let's just be honest. Like in this particular case, and it wasn't anything to do with individuals, it was just company and overlay regulations, right? But somebody else came in and closed it. And here's what it was. It was that Sharon rose to the occasion. She acknowledged it. She also made sure that she, helped the client through the situation and didn't leave them homeless. And that's the point. The point is to make sure that you're in alignment with people that are going to walk you through this process. And sometimes, when you're doing these internet mortgages or you're doing these internet realtors, they can't be in the mud with you. And that is a big difference in being in the relationship. Like I said, this deal got to the finish line. So this could have been a situation to where nobody saw it coming. And if Sharon or I would have been, on the internet and not in the mud with her in this market, she could have very well ended up permanently in that hotel. Right.
Right.
But it was us army crawling on our tummies through the mud. Like, what do we do? Where do we go? How do we do this? I think I had my whole team on it at one point. My ops manager was like, I don't know what I'm doing. And I was like, just find this information out. And so we got it done. So that's just something else I want to encourage you, and also when I speak to agents that I coach across the country, something I tell them is, listen, I think what's important right now is relationship. I think at the end of the day, when people do get in that point of what do I do? Where do I go? Is it good to sell? Is it good to buy? What is it? I think relationship matters, and helping people know that you care about them beyond it is a big game changer. So wherever you are, I would encourage you to just make sure you lean into relationship and to professionals that you trust, that that are going to be in the mud with you. So on that note, I think our first show went fantastic. What about you?
Yay!
If you guys knew how many Facebook messages back and forth it took to get here this morning, it was like, okay, we got to set this up. We got to do this. So, but we're here, and now we will be here every Friday at 9:30 Pacific Standard Time. We also have a Facebook page, Money Matters, and we have an Instagram page. We would love you to go like and subscribe those. Oh, we have a YouTube channel as well, of course. So YouTube, Facebook, and Instagram, please go like and subscribe, and please interact with us, ask your questions, share your stories. We really want to make sure that this is a show of value that helps you, your friends, and your family along in their journey to make better financial decisions. So thank you so much, Sharon. I super appreciate it. And I loved kicking off my Friday with you.
All right. Have a good Friday.
Bye, guys.